Hi, this is Al Carty. I want to thank you for tuning into this very important presentation. You're watching this video for one of two reasons. Either you're looking to replace or generate an additional income stream, or you're interested in the latest, most innovative financial products that can provide not only a blanket of security for you and your family, but also substantial tax savings. What you will see and hear today is a concept that impacts people that you can be passionate about. A smarter, more complete way to save money with higher income, more benefits, and tax-free. A multi-trillion-dollar business that pays billions to producers, and how you can make up for lost time and lost earnings. So here's the problem, folks. Most of the population's retirement, as a matter of fact, $17 trillion is in an IRA, 401k, 403b, or qualified plan, and a large percentage of that money will be lost to fees and taxes. In fact, the majority will outlive their income. Number two, 70% of the population will suffer a critical or chronic illness such as a heart attack, stroke, or cancer and live to age 65, but may be financially crippled in the process. And last, but certainly not least, 44% of the adult population cannot meet their financial obligations due to economic conditions. So let's get right into it. And really, what's the solution? Well, Freedom Equity Group. And we believe we're the solution because what we're all about is freedom. As a matter of fact, we liken ourselves to a crusade because we are building financial freedom for the American family. Our mission is very, very simple. We want to show every American how to save, grow, and retire, all tax-free with living benefits. In other words, financial freedom. Freedom Equity Group is a different kind of company. And the reason for that is we've got experienced leadership. Each of our owners have 30 years of experience in the industry. And you'll see three pictures of the top here of our ownership. Ron Blumenkemper to the left, Ron Petrinovich, our CEO and president, and Bill St. Clair, our chief operating officer. They have a clean track record. They've built, in one company, they've built over 48,000 agents. They've been number one producers as a producer group with many insurance companies. And the reason for that is because we've got a proven turnkey system. We've got the best team building system ever out there in the financial service business. We've got a product that fits everyone, that everyone can afford, and we've got an easy to follow income building system. Now, let me just real quick housekeeping here. What I'm about to share with you in this presentation is you're going to see some statistics, some information. This is for illustrative purposes and educational purposes. We don't proclaim to be CPAs or attorneys, so we're not giving any tax or specific legal advice. So problem number one, most of the population's retirement, 17 trillion, is in an IRA, 401k, 403b, and a large percentage of that money will be lost to fees and taxes, and the majority will outlive their income. So it's a big problem. Where do most people save for retirement today? Most people are saving in an IRA, a 401k, a qualified plan that are fully taxable. And today, there are 90 million people that invest in these type of Wall Street type of accounts called qualified plans. But there are many roadblocks along the way. As a matter of fact, there are four, and we want to make sure people understand what these roadblocks are. And the first is procrastination, risk, fees, and of course, taxes. So let's start with procrastination. When you look at the average person, if we said, well, I'd like to have a 20-year monthly income at retirement, whatever that age may be, with an assumed interest rate of 8%. If I wanted to have $5,000 a month, what would I have to put away? Well, it's pretty simple at age 20. It's only about $113 a month. The problem is what's happening at age 20. If you think back to when you were 20 years old, what were you doing at that time? Was putting money away for the future on the forefront? No, it was having a good time. It was going out with your friends, dating, that kind of stuff. Well, what about at age 30? Well, now you need more than double the money. The problem is now at 30, you may be married or may have been married with children. Well, now it's hard to save money. Well, in your 40s, well, I can't do it then, even though it's almost 3 times the money again, because now I've got kids, travel, soccer, baseball, football, different types of sports that they're in, hotel rooms, you're spending a lot of money. Well, how about at age 50? Well, at age 50, the kids are going to college. So now I don't have any money. It's all going out to tuitions. So now I'll wait till I'm age 60, and all I need to do is put away $8,100 a month, for 5 years so I can have an income of $5,000 a month. So you can see procrastination has hurt a lot of people. And Americans, as a country, we are some of the worst savers in the world. Now, the question becomes, is this the best place to put your retirement nest egg? Well, Time magazine disagrees. They said, look, the ugly truth is that the 401k is a lousy product, a financial flop. Now, folks, we don't say that. Time magazine said this back in October of 2009. And one of the primary reasons is the high risk. And what you're seeing here is a chart of the S&P from 1997 to 2012, or a 15-year chart. And when you look at that chart, it looks like Rocky Mountains. It looks like a roller coaster. It looks anything but, secure. All right. There's tremendous amount of risk in Wall Street type accounts, and you weather that risk regardless of what you think you may or may not know in the marketplace today. As a matter of fact, most people have no idea how the market can be impacted by something that happens in another country. So there's a tremendous amount of risk when we talk about Wall Street accounts and 401k accounts. We have to keep in mind that how do people find out about 401ks? They go into work one day and there's a notice that goes out and that says, we're having a meeting today in the auditorium or the cafeteria, and we're going to talk about your retirement plan. And everybody comes into a meeting and they spend about an hour there, and somebody is going over with them the different types of funds that they're putting their money in. And in 1 hour's worth of time, we're expecting people to become pension fund managers. The reason why you see people crying on 60 Minutes because they're retired and they don't have enough money and they thought it would be different is because they never understood the risk associated with these Wall Street type accounts. The second reason is the fees. This publication talks about the hidden costs of 401ks, and up until recently, they weren't even disclosed. The average 401k or qualified plan has a 2.99% fee. That's annually on the amount of money in the account. Now, folks, just to put that in perspective, 2% over a 30-year period of time would cost you half your retirement income, just 2%. So just imagine what 3% is doing. The average 401k has $155,000 of fees per account per this publication. And the last one is taxes. Now, this one here, most people today think we pay too much in taxes. But if you really think about the last 100 years since the IRS was born in 1913, there's only been 2 times in the history of the last 100 years where taxes have been lower than they are right now. In fact, right now, our top marginal tax bracket is 39.6%. But if you look back into the World War II eras, it was 94%. In the 50s and 60s, as high as 91%. Try to imagine every dollar being able to keep only 9 cents. A big problem. So where are taxes going in the future? Well, we have to take into consideration that anything that is in a tax deferral type account, we have a partner, and that partner is the IRS. And our government has not been the most fiscally responsible partner that we could have, and we have no idea where they're going. As a matter of fact, if you had an opportunity to opt out of the tax system and pay lower fees and never ever lose money again, wouldn't that make more sense? Well, where do you think taxes will go? Well, look at this chart since 1929. Government borrowing has risen, and I'm not going to read it to you, but here's what it says. If you look at the gray here, this is government spending or government borrowing, excuse me. And if you look at the tax rates, they follow what the government has done. So you can see here right in the World War II era in 1945, you'll see the government spending or borrowing went way up, and look at the taxes. Taxes were as high as 94%. And then you'll notice when government borrowing went down, look at what happened to the tax rate. Well, look at where we are today, and let's take a look at where government borrowing is. Where do you think taxes are going? You're right. They're probably going to go up. If this chart is accurate and it's over 85 years old, one would have to believe that taxes would have to go up. So therefore, when we look at the 4 retirement phases of retirement planning, the first one starts with the contribution. If we look at the typical qualified plan, IRA, 401k, what have you, it is tax deductible. So what are we actually saying? No, I don't want to pay the 39 cents on a dollar today, and I'm going to defer it to the future where, based on the previous chart, more than likely taxes will be going up. So what we're saying is, I'm going to take a tax deduction today. I'd rather not pay the 40 cents today to probably pay it back later in the future. Wouldn't it make more sense to know that we've got a finite number, 40 cents, pay the tax today, not defer it out into the future? Because when you do decide to take the money out, when it has accumulated, now that's when the taxable consequence is going to come into a place. Meaning when you withdraw the money or when you're transferring it to a non-spousal heir. What's the alternative? The alternative is what we consider to be a tax-free alternative. You don't take the tax deduction today. It is still classified as deferred. However, when you need it the most, it is a tax-free benefit. When it transfers to your heirs, taxes, tax-free benefit. So our solution is pay taxes now on the seed or higher taxes later on the harvest. So what's the solution? Well, we call it the tic-tac-toe of finance, where you win every time. See, most people today, anybody who's putting any money away, investing or saving money, what they really want is safety of principal. Nobody ever wants to lose money. But the only place you can do that is in what we call fixed products. That's bank accounts, CDs, savings accounts, but those are typically associated with low rates of return. The opposite to that is upside potential. Well, that can only happen in, we call them variable products. However, those are Wall Street type accounts. The problem is the risk is still associated with those accounts. So in order to have the upside, you've got to be willing to risk the capital. Well, that's why we call this the tic-tac-toe of finance. It's called index products, where you get the safety of your money, but you also get the upside potential. The best kept secret, the underused and until now overlooked IRS Section 7702, your money never goes backwards. All your gains are locked in. It's absolutely 100% liquid, access to cash anytime, for any reason, without penalties, and yes, it's tax-free. The secret of the ultra-rich have been publicized by many different authors. Two in particular here, and this has become a national bestseller, The Tax-Free Retirement by Patrick Kelly. This talks about the alternative tax-free retirement planning. In fact, another publication from an author called Richard Hinderer, he's a CLU, he writes Common Sense Retirement, how to get 300% more spendable income. What Wall Street doesn't want you to know about your money. Well, let me ask you a question. Who wouldn't want to have 300% more spendable income? So if we go back to a chart I put up earlier, and we call this red line, and you'll see this is just a little blown up here. This is the S&P over the last 15 years. You'll see that it's a pretty rocky road. However, what if you could have something like the blue line? So if you knew nothing about our business and nothing about investing, and I showed you this one chart, and I said, if you had an opportunity to take $100,000 and put it away, what line would you want it to be on? Would you want it to be on the red line or the blue line? Well, I'm sure you'd all pick the blue line. And there's a number of reasons why. Number one, it's got a higher value at the end of the 15-year period. But looking at it more closely, what do you notice about the blue line? Well, it doesn't quite go as high as the red line. But look at what happens when the red line goes down. Stock market declines. What happens to the blue line? It stays the same, meaning it never goes backwards. Again, when it goes up, as it did back in 04, 5, and 6, you'll see that the blue line went up, not quite as high as the red. But look at what happened in 2008 when most people suffered a 38% loss. Look what happened in the blue line. So your money never goes backwards, it only goes upwards. And by the way, folks, this gets worse, because if you look at the red line, the one thing that's not factored in here, because this is what the S&P has done, which is one of the leading indices used for comparison purposes because it's the most stable, what's not factored in here is the fees. Well, let's take 3% of 100,000, 3% of 117, 3% of 140. As a matter of fact, whether it goes up or down, you pay the fee. You get penalized if you do well, because the more your account grows, the higher that fee is per year. 3% of an ever-increasing number means that you have an ever-increasing amount of fees that are associated to your account. So if you took 3% out of this over the last 15 years, that's at least another $45,000. And there's one last piece of this here is taxes. Of course, this is not factored in for taxes. This would all be 100% taxable. Now you understand why most people have said this has been the lost decade. I have gone nowhere. I was better off 10 or 15 years ago than I am today. Statistically, that's true because most people have their money in these type of accounts. Problem number 2, folks. 70% of the population will suffer a critical or chronic illness such as a heart attack, stroke, or cancer and live to age 65, but may be financially crippled in the process. This is a serious problem, folks. Every year, over 6 million Americans suffer a heart attack, stroke, or cancer. 1.2 million Americans suffer a heart attack every year. 17.6 million Americans alive today have survived a heart attack. So what does that tell you? That tells you that medicine has evolved, awareness has evolved. So there are more and more people today, as opposed to years ago, you had a heart attack, you just died. Now more and more people live because of awareness in medicine and innovation of medical services. Same thing with strokes. Each year, almost 800,000 people suffer a stroke. Many end up with permanent disabilities, but they're still alive. Cancer, 3.5 million new cases a year. Average cost over $140,000 of expenses. Over 65% of the expenses are indirect and not covered by traditional insurance. So there are 11.7 million people currently living today with cancer. But what do? See, you can protect against these type of things with different types of insurance, right? So when we talk about someone who has a disability, well, if they purchased disability insurance, well, they would be protected, right? If they purchased life insurance, they would be protected, of course, if they would have died prematurely, right? As a matter of fact, they call it life insurance, but in reality, is it really life insurance? Most people who own life insurance realize that is a benefit paid to someone else. So is it really life insurance or is it death insurance? Critical illness. You could buy a plan to cover critical illness. You could also buy an insurance program that covers a chronic illness like a long-term care. The fact is, all of these are important, but all of these come associated with the cost. Well, so what's the solution? Living benefits. What if there was a plan that would protect against critical illness? So if you had a heart attack, stroke, cancer, or major organ transplant, you'd be covered. Chronic illness, unable to perform 2 of the 6 daily living activities, or cognitively impaired, or a terminal illness. And you could have these all at no additional cost with the right product or the right service. So what if there was a product that protected you and your family from market risk without losing the upside potential, that provided liquidity without restrictions, allowed access for college education for your children, protected you and your family from financial devastation, solved the issues of critical, chronic, and terminal illness, all while providing for a tax-free income that you cannot outlive? Well, there is. We have a solution for every family, and there's 2 products that may cover many financial needs. The first product is term insurance. Most people are familiar with term insurance. It's real simple. It provides an income tax-free death benefit. You have to die for someone to get the money. There are no living benefits, and essentially, you have to die to use it. Well, that's the old term. Now there's a new term. The new term still provides an income tax-free death benefit, but it also has a no-cost critical, chronic, and terminal illness rider that can have up to a 90% payout while you're still alive. It's a fully convertible product to a permanent form of protection, but it provides living benefits, meaning you don't have to die to use it. You can be paid while you're still alive to cover situations that may occur. The second product is what we call Index Universal Life, and it is truly the retirement solution. This is what the banks and wealthy have been doing for years, and we just bring it to everyone else now. Again, it's called Index Universal Life. We call it the Swiss Army knife of finance. Tax-free money when you need it the most. See, folks, we got you covered. If you live too long, or you get sick, or you die too soon. So it's life insurance you don't have to die to use. Problem number 3. 44% of the adult population cannot meet their financial obligations due to economic conditions. A lot of things have changed. So what's the solution? Well, we call it the tale of 2 brothers. Our story begins with two brothers, both age 35, both saving $600 a month, both earning 8% interest for the same period of time, 30 years to age 65 or the retirement age. Brother A believes in the old way. Save for retirement in qualified accounts, receive a tax deduction, and pay taxes later. Brother B believes in the new way. Save through the innovative product called Index Universal Life and receive tax-free income later. So Brother A contributes $6,500 a year into his 401k, and he gets an employer match of another $1,000 a year. And what he does is he buys an old term. He pays $680 a year for a $600,000 term policy, which will cover him for 30 years. Brother B, on the other hand, decides not to take the 401k contributions, no employer match, and he puts $600 a month into an Index Universal Life with a $600,000 benefit. Well, let's see who made the right decision. 30 years go by. Brother A has accumulated $158,000 in his 401k. Now he no longer has insurance because he had a 30-year term, and that has now expired unless he wants to continue to pay $12,000 a year for that insurance. But he did save $65,000 in tax deductions, so he has a total of $858,000. Brother B has $709,000 in his cash value in his Index Universal Life. Still has a death benefit of $864,000. He has no cumulative tax deduction. So when we look at the sum of money, Brother A's got $858,000. Brother B has $709,000. But it's not how much you make, it's how much you keep. Well, let's look at the most important thing, and that is distribution at retirement. How much money will this provide as an income stream when you're retired? Well, Brother B can take annually $97,000 a year from his Index Universal Life plan forever as a tax-free loan. If Brother B dies at age 100, he would have received over $3.3 million and left his family over $3 million in a tax-free death benefit. Well, Brother A, to have the same amount of money come out, he has to take $129,000. Why? He's got a partner. That partner is the IRS. So at a 25% tax bracket, for him to end up with $97,000, he needs to take out $129,000. Well, unfortunately, Brother A runs out of money in 9 years at age 74, completely out of money because of the taxes associated with that account. So which plan makes you feel more financially secure? I've got two questions for you. Number one, if you were Brother A, would you want to be Brother B? I'm sure you would. And if you knew someone who was Brother A, would they want to be Brother B? Well, I'm sure they would, right? And this is essentially taking someone from the red line to the blue line. Every time we do that, folks, every time we help a family just one time a month at an entry-level position, you earn as much as $1,200 per month just to help one family. That's over $14,000 a year part-time. And you know what? If you just did it twice a month, you could earn up to $30,000 a year. And there are many people in this country today not earning $30,000 a year annually. Now, just before I get into a little bit more here on the entrepreneurial side, here's what I want to get across to everyone. Let's not lose sight of what $1,200 does for a family today. If you think about your present situation, whether you're married, have children, doesn't matter, whether you own a home, what would an extra $1,200 to $2,400 a month coming into your household mean to your family right now? As we move on to potentially larger incomes, we don't want to lose sight of value of extra income to a family. However, for those of you that are have the real entrepreneurial spirit, I liken our business a lot to real estate. In this respect, that the real estate agency, typically you have two positions in a real estate agency. You have a broker, and the broker typically owns the company, and you have agents that work with or for the broker. And essentially, every time an agent makes a sale, they actually earn 3%. When the broker makes a sale, they earn 6%. So in fact, they earn a 3% royalty or override every time one of their agents makes a sale. So as it relates to real estate, I'm sure if you were going to be in the business, you'd probably rather be the broker for a couple of reasons. One, because you're in control of it. And secondly, because you earn a lot more money. And now you're building an income that you are not solely responsible for. Well, here's one fundamental flaw in this type of agency type system is that occasionally you're going to have agents that are aggressive, that have done well for themselves. And here's what happens. They're going to come in someday and they're going to say, listen, I appreciate all you've done for me the last 2, 3, 4 years. But you know what? I've decided that I want to become a broker. And they actually go out there and they open up their own realty, maybe even down the street from you, and maybe even take 1 or 2 of your agents. So in this type of system, you've trained your competition.
Our program is unique because it's more of what we call a profit share program. We have some entry-level positions here as sales rep to division managers. Matter of fact, the example we used of earning $1,200 helping one family is that of a sales rep. But we also have what we call a broker type position, which we call a vice president. They earn anywhere from 75% to 87%. What they have the ability to do, just as a broker would in real estate or a typical agency, they have the ability to bring other people on board our company to expand their business and build their agency. So in the case of them bringing people on board, we'll use Bill, Mel, Pat, Sue, and Tom. The real unique difference between our system and the general agency system is you never lose your top producers. And as these 5 people perhaps go on to become successful, maybe open up offices in different parts of the country, you earn from 9 to 21% on their production as long as they continue to perform in the system. It really is a 6-figure income type model. And let me give an example. As a vice president, if you helped our average client, which is about $300 a month, now keep in mind the tale of 2 brothers, we talked about $600 a month, but just helping 5 families a month, that's essentially $100,000 or $97,000 annual income. I pretty much call that a 6-figure income. And what if your business just grew a little bit larger to a 10 sale a month business? I'm sure you'd all agree that's not a huge business. That's you working with a handful of people like Bill, Mel, Pat, Sue, and Tom and earning potentially a couple of $100,000 a year. Well, just as in the broker or agency world, there will be people that want to branch off and do their own thing. Well, the uniqueness of our model is you don't lose those people. So in the case of Bill, Mel, Pat, Sue, and Tom, let's say they went out there and duplicated your business, where they went out and opened up an office perhaps, or started generating an additional 10 sales a month each. Look at what happens to your income, folks. It grows to over $500,000 a year in our business. I'm not trying to over promote this. I'm really just trying to simply help you understand that the opportunity exists if you choose to build your agency. Now, how can this all happen? It's because we use a system. Some of the great companies that you're familiar with, companies like McDonald's, Starbucks, and I put Freedom Equity Group in that category. Why is that? Because they all use a system. McDonald's does it with hamburgers. Starbucks does it with coffee. We do it with financial services. Matter of fact, our goal is to build a system or build duplication within our system. And our system is proven, it is predictable, and it is duplicatable. Our goal is to have 50 plus offices in every city across America. And we absolutely know we can do that because we know how to solve the industry's #1 problem, and that is prospecting, how to have an unlimited warm market of people to speak to. So the FEG difference, just to summarize this all for you, our crusade is about teaching people how to retire with dignity, how to protect their families with the tax-free income. We have higher commission payouts than the competition in our space out there in America. We believe in training. We take great pride in providing some of the best live weekly training for our agents and producers throughout this country. And I believe with our 30 years of experience, a clean track record, compliance-minded, and long-range decision thinkers, we are poised to be here for the long haul, building value for families across America. So where do you see yourself? Perhaps as a client. You've recognized from this presentation that you have the old type of term insurance and you need to upgrade that to the new type of term that has living benefits. Or maybe option B is that you're looking for that tax-free retirement income with living benefits, a tax-free income that you cannot outlive. In addition to that, Maybe you'd like to earn some extra money working with us part-time, either as a part-time agent or a paid referral agent, which we'll explain to you. And last but not least, maybe some of you really don't like the profession you're in. Maybe you hate your job. Maybe you hate your boss. Maybe you're just looking for something completely new. We give you the ability to transition on a part-time basis and become a full-time producer with a potential six-figure income your first year, folks. And that is no joke in our business. So what's the next step for you? Set up a one-on-one meeting, preferably in the next 24 to 48 hours, to see if this is right for you. You can do that live or online. Get your questions answered. Learn about our training program. Find out how to begin your process of getting trained. Determine how much time you can devote to our business. And last but not least, the income potential. The next move is yours. Get back with the person who invited you to this presentation and find out how to get started. Thank you.